Hi, folks. Welcome back to Marthi Finance Academy. Let us start. Today, we're really going to dig into the economics of wind energy. So let's just jump right in. Solar seems cheaper, it's growing like crazy, so why are we even talking about wind? Well, this question really gets to the core of how our entire energy grid is being re-engineered. You see, on the surface, yeah, solar's cost curve looks amazing, totally unbeatable. But the real story, the economic story, is all about the system as a whole. It's about complementary assets, not some simple horse race between two technologies. Okay, first things first. To get this, you have to understand the main driver behind all of this. India's absolutely relentless, unstoppable thirst for more and more power. Just look at the numbers. Over the last 10 years, our national energy requirement has shot up by more than 60%. And let's be clear, this isn't some temporary cyclical thing. Nope. This is a deep structural shift. It's being driven by industrialization, the switch to electric vehicles, and just rising incomes across the board. This demand is huge, and it's not going away. That creates a massive, non-negotiable incentive for anyone, to invest in new power capacity. So, how we actually meet all that demand? Well, that's where wind's true economic value really starts to shine. See, it's not just about how much power you can generate. It's about when you generate it. And that timing has huge implications for keeping the grid stable and keeping costs down. Think about it. Solar power is fantastic, but its schedule is set by the sun, right? It peaks right around midday. But when do we use the most electricity? It's in the evening, usually between 6 and 8 p.m. when everyone gets home. So you've got this fundamental mismatch, this daily gap between supply and demand, that someone, the grid operator, has to figure out how to solve every single day. And honestly, that timing gap, it's the single biggest headache, both economically and from an engineering standpoint, for a grid that relies heavily on solar. Sure, you can say just store it in batteries, but right now the cost of doing that at scale it's still way too expensive. So the billion-dollar question is, how do you solve this puzzle without breaking the bank? And here's the elegant economic solution: wind power. Wind generation isn't tied to the sun at all. In fact, it's often the opposite. Wind speeds frequently pick up in the evening and through the night. This creates a kind of natural hedge, filling that exact gap that solar leaves when the sun goes down. They're not competitors, they're partners. They're complementary assets. Okay, so to really measure the economic impact of this partnership, we need to talk about a key metric called the plant load factor, or PLF. The easiest way to think about it is like a utilization rate. It just asks, how much power did this plant actually produce over a year compared to what it could have produced if it ran at full capacity 24/7? It's a fantastic way to see a plant's true economic productivity. And this PLF number, it really shows you the core economic difference between renewables and traditional baseload power. A solar plant, for instance, has a pretty low PLF, maybe around 18%, because, well, the sun isn't out at night. A wind farm does a bit better, maybe around 30%, but compare that to a coal plant, which can run at 70% or even higher, just pumping out consistent, reliable power whenever you need it. And that intermittency is exactly why you can't just swap 1 megawatt of coal for 1 megawatt of solar. It's just not a one-to-one replacement. And this is where the economic magic happens. This is the big payoff. If you take solar or wind by themselves and add the expensive battery storage they need, you're looking at a cost of around 10 rupees per unit. It just doesn't make economic sense. But when you combine them into a hybrid plant, because their generation profiles offset each other, you suddenly need way less storage. And the cost? It plummets to about 2.8 rupees per unit. That's actually cheaper than conventional fossil fuels. That is why the hybrid model is so economically powerful. All right, so now that we get the core economics, let's follow the money. We're going to break down the industry's value chain to really understand who is capturing the profits and, more importantly, why. The value chain itself is pretty straightforward. You start with the basic components and materials, think steel, carbon fiber. Then you have the turbine OEMs, the folks who actually manufacture the core equipment. After that, the EPC firms come in to handle the development and construction. And finally, the whole asset is owned by power generators, with O&M companies providing that crucial long-term service and maintenance. So where's the real economic power concentrated in all of this? Well, it's all about the turbine. The wind turbine generator itself is by far the single biggest expense. We're talking a massive 70 to 75% of a project's entire cost. When you control something that essential, you get immense pricing power and a ton of influence over the entire value chain. This cost structure naturally creates a huge incentive for companies to become vertically integrated, what we call full-stack players. These are the big guns. They don't just manufacture the turbine, they also control its installation. And, this is critical, they lock in those juicy, high-margin recurring revenues from long-term maintenance contracts. So they control the biggest cost item and the most predictable profit stream. You can see how that leads to much better returns on their invested capital.
Now, the way the industry looks today, dominated by just a few really strong players, that wasn't an accident. It didn't just happen. It was actually forged in the fire of a policy-induced crisis that forced a painful, but honestly, a necessary wave of consolidation.
So before 2017, the game was pretty simple. The government offered stable, fixed prices for wind power. This created a nice, low-risk environment for investment. But then in 2017, everything changed. The government switched to a competitive reverse auction system, and that completely flipped the incentive structure on its head. It basically kicked off a brutal price war. Companies started bidding super aggressively just to win projects, often at prices below what it even cost them to build. This, as you can imagine, completely destroyed profitability across the entire industry. It drove the weaker, less disciplined companies straight into bankruptcy and forced a massive consolidation. In the end, only a few financially strong survivors were left standing.
All right, so fast forward to today. The onshore market is now much more stable, much more consolidated. And so the industry's focus is shifting. It's looking out to sea to the next massive growth frontier, offshore wind. Now, offshore wind is a different beast entirely, with a very different economic profile. First off, the upfront capital cost is way higher, maybe 50% higher. But, and this is a big but, it completely solves the massive headache of land acquisition that you face onshore. And even more importantly, from a pure productivity standpoint, the winds at sea are just stronger and way more consistent. That means you get higher PLFs, so a single offshore turbine can pump out 2 to 3 times more power than an onshore one. We're talking far superior asset utilization. The government knows that this high initial cost is a huge barrier to entry, so they're stepping in to change the project economics. They're offering something called viability gap funding. What is that? It's basically a subsidy. Its whole purpose is to de-risk these huge projects and sweeten the deal, improve the return profile enough to make them really attractive for private investors to jump in. So putting this all together, what should we be watching for? What are the key signals and, of course, the risks that will tell us how this industry is going to evolve from here? A few key things to keep on your radar. First, you absolutely have to watch the policy environment. I'm talking specifically about things like renewable purchase obligations, or RPOs, which basically force states to buy this power, creating mandated demand. Second, you've got to track the actual pace of offshore project awards. Are they moving from talk to reality? And finally, keep a close eye on the real-world adoption and performance of that hybrid solar wind model, because as we've seen, that's the real key to unlocking the best project economics in this space. So all this brings us to a final thought. Maybe we've been asking the wrong question this whole time. Maybe the real story of wind energy isn't about competing with solar or beating it. Maybe its greatest value is as solar's essential partner, the partner that makes the entire renewable grid work better, cheaper, and more reliably for all of us. Thanks for tuning in. If you like the video, please like, share, and subscribe. Disclaimer, I'm not a CBI registered research analyst. All stocks discussed in this video are purely for educational purposes only. Do not consider it as buy or sell recommendation. Do your own research or consult a financial advisor.